Hey everyone, Shane Brennett here from Crypto Tax Calculator. Thank you for allowing me to present at the virtual CPA conference. Today I'm going to be talking all about cryptocurrency and common tax issues, along with Harrison Dell from Chamberlain's. Harrison used to work at the ATO, and we've been doing quite a lot of work with you to try to uncover some of these cryptocurrency tax issues.
Yes, that's right. And Shane, thanks for having me along, and thanks to CPA Australia for having me along as well. Everything is new in this space, so it's all a bit of a moving feast, and I don't think anyone knows that better than you and I, who are trying to get some of these answers out of the ATO and everyone else. But it's a lot of work, isn't it?
Absolutely. I think there's still, it's a brand new kind of technology, and there's not a lot of people who truly understand some of the complexity around this yet, but we're trying to get through it piece by piece. So, yeah, look, what I wanted to talk to everyone about is, if there's one thing you can take away from this session, is that cryptocurrency is not just Bitcoin. It's not just about buying and selling and speculating on assets that might or might not have value. There's actually something interesting about this technology and how it allows you to do things financially without having to take custody of the asset. So beyond just, about 1 million Australian users currently trading cryptocurrency, and most likely that's going to continue increasing, we're starting to see actual use cases. So there's this thing called Ethereum, which is essentially, the idea behind it is that it's a global computer, and you can use Ethereum to pay for resources on this global computer, which is in itself pretty interesting technology. There's these concepts that are emerging from that, such as non-custodial peer-to-peer lending. So I can lend Harrison crypto through a protocol without having to go through a third-party intermediary. So the easiest way to think of this is it's a bit like what BitTorrent and torrenting did to music. That's what this cryptocurrency technology is starting to do with the financial sector. It just frees up a lot of capital. All that capital that is usually reserved to managing and regulating third parties is no longer needed with some of this technology. At least that's the dream. And you tend to get a lot of market efficiencies, and finance tends to like market efficiencies. You've also got some emerging technologies such as NFT marketing strategies that are coming out. So people like NBA are actually using NFTs to market as a go-to-market, like an actual way of selling a product. And there's obvious things like cross-border remittance, so sending, funds across borders and the efficiencies around that. And there's this growing interest in central bank digital currencies. So it's foreseeable in, say, 10 years maybe, that the Australian dollars would be actually, a cryptocurrency managed by the central bank, and you can actually bake in a lot of economic policies into that Australian dollar and actually make it programmable. So they can have policies where they might, give out a COVID relief payment, but actually incentivize people by only allowing them to spend that payment on certain goods and services. So you can actually bake that programmatically into the currency. So this is, there's quite a bit of interesting things there, but what we're going to be talking about is what are some of the complex tax and legal perspectives around that. So what is crypto? It's really just a proof of concept at this stage. The idea is that you can build decentralized financial products that don't require custody. So you could almost think of blockchain technology as a triple entry accounting system. So everyone's heard about double entry accounting. But what this is basically a bunch of different third parties who all verify that a particular transaction has occurred. And once that transaction has occurred, it goes onto a public ledger. And, we say triple, but there's many third parties are always making sure that nobody changes that ledger. So it's like a publicly visible audit trail. And in my mind, cryptocurrency, like the underlying blockchain technology, would be pretty valuable, even if it was just pegged to US dollars, and even if Bitcoin wasn't involved, etc. There's actually something about the underlying technology that can be used for a lot of different things. You can think of it almost as though it's a communication standard between multiple different third parties that have all agreed upon the same protocol to communicate. Whereas right now, you've got silos of information in different corporations, and it's in different databases, and you have to talk between the two parties and try to reconcile the transactions by pulling in the transaction history from one party to the other. Whereas in the world that we foresee in the future, there's a standard common protocol, so you don't have to do that reconciliation process amongst different silos of information. Practical implications include perhaps having automated reconciliation of invoices. So if somebody pays an invoice, that can be automatically reconciled against the bank statement as the payment is made. And obviously transaction histories that can't be compromised, so that that it goes back to that publicly visible audit trail. Some of the case studies that I've got for you is we've got examples of companies, like I mentioned before, NBA Top Shots, that are doing $750 million in volume trading. Basically, it's like NBA basketball cards, but they're virtual. You've got Arizona Iced Tea buying up these NFT tokens as actual assets that they're putting on their balance sheet. Budweiser recently bought $120,000 worth of fan art that created a bit of a PR stir. And there's Coca-Cola, Gucci, and the US Open doing a release of NFTs where they're actually selling NFTs as a revenue source. And the way to think about NFTs is it's kind of like a virtual collectible. It's like a one-of-a-kind collectible. It's quite interesting. There's also this concept of decentralized finance, DeFi they call it. So you can actually trade peer-to-peer now without having an actual exchange. It goes back to this concept of the BitTorrent idea that we had before, where you could download music directly from someone else's computer. Here you can actually do cryptocurrency trading directly with somebody else without having to go through a third-party intermediary that holds your funds. Instead, it's like a program that is uploaded to the global computer. And people are using this. We can see on the right there the daily volume of the ASX, the daily volume of the S&P 500, and then furthest to the right, you've got the daily volume of DeFi. And you can see it totally dwarfs what's going on in these other markets. So it's already here is the point. It's not just a pipe dream, and it's got a lot of traction. You've got this idea of peer-to-peer permissionless lending. So you can actually go on to the internet today, deposit something that's equivalent of US dollars into this protocol and earn interest on it. And you can actually earn 6-7% interest, and somebody else can borrow that money to do something to do with cryptocurrency trading often. But there's a number of startups that are coming out that are looking at kind of making this friendly from a retail perspective. So you can actually have peer-to-peer lending, but without a financial middleman to take a cut. And obviously that's got a lot of efficiencies from a capital perspective. And then you've got these algorithmic stablecoins, which they're designed to stay at the same price as the US dollar without actually having US dollar backing. They're just algorithmically, like from a computer by balancing a range of assets. They're pegged to the currency. And there's $133 billion locked in these stable coins. So there's a lot going on. And back to my point previously, it's not just Bitcoin. I'll let Harrison join now to talk about the tax and legal implications.
Well, thanks, Shane. Look, tax legal implications, you need to balance them up with your just running your business, how you're actually going to integrate the use of cryptocurrency or blockchain technology in your business is not as easy as just setting up a wallet. You've got a range of things to consider. Is it accepting? How are you going to do that? How are you going to convert it back to dollars? How is it going to look on your balance sheet? Whether you have any obligations, KYC obligations on your client, or your customer, or anti-money laundering rules that may apply to you. And of course, the tax implications. And there's always new novel scenarios that arise in this space. And we're not just seeing this on the fringes. We're seeing institutions and large businesses actually using blockchain technologies in unique ways, and in ways the regulators are not yet thinking about. So payment providers, there's a whole lot of missteps that happen here. And it comes from the thinking that with normal banking, if someone sends a transaction, you can reverse it. It may take a bit of effort. There's a fraud department that can help you if someone misappropriates funds. In blockchain world, in crypto world, that is not a thing. If you send a transaction, it is permanent. So you need to make sure that when you're dealing with your customers, your clients, or other businesses, and you're dealing in cryptocurrency, whether it be a stable coin, a central bank currency that, I think 10 years is an overshot. I think we'll see it in the next 2 to 3 years. You need to think about, well, how are we going to accept it and minimize our risk? So you can use third-party existing payment systems. A big one in Australia is Oz Merchants. That's recently become quite large. There's also simple things that you can put a plug-in on your website. People can pay with Bitcoin, and that gets processed in a particular way. You need to remember that those things are irreversible. And how would you do things like refund a client who is unhappy, refund a customer who gets bad goods, those sorts of things. You could also run it in a way where someone will just directly send amounts to your wallet. Now, I'm a crypto guy to some extent, and I wouldn't just send anything to someone else without there being either a protocol to get what I want or at least a reputable business. So a lot of people will not be happy to do that because it's just sending it out and hoping to get something back. And as I said before, these are irreversible transactions. The last alternative, which is what a lot of businesses have been doing in this space, especially when they deal with larger transactions, is they'll just set up an account through an Australian-based exchange or whatever country you're in, where you can then receive the currency into that account and liquidate it immediately. That is often the way to go if you're going to transact a bit, but if you're going to use your business and pivot to cryptocurrency and blockchain tech, you need to get a long-term solution. Now, everything's well and good in crypto world. You're getting US dollars, pretend US dollars, Bitcoin, whatever it is that you are receiving. Actually finding a bank that will assist you to convert that back into real dollars is a little bit of a problem. So in Australia, we've got the big four banks. A lot of them are very reluctant to engage in the crypto space, naturally because of a lot of anti-money laundering laws, know your client, know your customer laws, things like that. They are not confident in the sector yet. That will go away in time. But at the moment, if you're using a bank, they may not be comfortable with those activities. You may need to run those activities through a different and more specialized bank. And those banks do exist. And those banks are still quite reputable. Coming all the way back to AML, CTF obligations, that's anti-money laundering and counter-terrorism financing. Digital currencies are treated the same as cash for those laws. So if you're doing a transaction that's over the $10,000 threshold, you may need to put in a report to AUSTRAC. Depending on your kind of business. If your business is, large transactions, and I've dealt with a few of these before, such as dealing in luxury vehicles, secondhand watches, that's a big one in this space. Actually having to make that AUSTRAC report, it might be the first time in your business that you need to do it for digital currency, and it can throw people a bit out. Getting some professional help, getting an agent to do it for you may be the way to operate. Now, it's all well and good to be doing these things in your business, but one of your risks as a business is misappropriation of funds. And again, these transactions are permanent. You can't go and erase them because they are maintained on a public ledger you can't go to anyone and say that was fraud. It is gone. And it's happened in DeFi. It's happened in other spaces where millions of dollars have been taken. And it happens all the time to private investors who are not careful about their security. They lose access to their cryptocurrency. The most important thing to protect is your private key. And your private key may have a range of different names depending on what service that you use. So a private key can also be called a seed phrase or something, or a recovery phrase. Basically, it will be a collection of words that when you implement it, when you type them into the application, whether it be a MetaMask wallet or anything else, you'll be able to recover everything in your wallet. And of course, you need to keep that phrase extremely safe. And the bigger that you get, the more likely you'll be a target for hackers. It's very well known that you should not keep this piece of information anywhere on a computer. So you don't save it to your OneDrive, you don't encrypt it because those things can be broken. It's just not secure enough. There are some software arrangements arising, such as fragmenting phrases. So storing it in different parts on different computers so that if someone hacks one, they can't get all of it. Things like that. But from a practical perspective, if you're going to deal in cryptocurrency and you've got a significant flow, you're going to be holding quite a bit at any one time. Insurance is going to be a big factor. And yes, you can get insurance on your cryptocurrency wallet. So you can either go through a platform that has insurance or it offers insurance on accounts. Those accounts are what we call custodial wallets. You don't have the private keys. Someone else has the private key, but they have insured your amount, and that costs money, of course. Or you can have your own wallet, your own security processes, and get that insurance yourself. That insurance is not cheap, but of course, they will require very stringent security measures to be taken. Now, that's all the legal stuff aside. Now, the exciting stuff for me is tax. And the tax is a complete dog's breakfast because we just simply don't know enough in this space yet. That combined with there's new things every single day, there's new kinds of projects, there's new lateral thinking in this space. The regulators are very, very, very far behind. But from a business perspective, what we're going to be thinking about is the trading stock rules. So the trading stock rules basically align tax and accounting together. Things go up and down through the year. You do a bit of a stock take. You treat it like it's goods and services that you sell. Now, that position is not always the case, but that is really all we have from the tax office in Australia. There are many, many cases, depending on how you operate and run your business, that you're going to need specialized accounting and tax advice to actually integrate this into your business. There are a lot of novel scenarios too that need some ATO engagement, like NFTs in business. I was talking to Shane about this earlier, that we aren't sure on some of the tax treatments for NFTs, lending type products. You're going to have ASIC issues. You're going to have AUSTRAC concerns, as well as the usual suspects in regulatory land, which is initial coin and token offerings. They are often treated as securities. You need to be very careful when you're doing that from Australia. It just takes a bit of professional advice to make sure that you're going the right direction with it. Now, just to refresh, just generally, an investor or even a business that holds crypto passively, they'll be subject to the usual CGT rules. That much is pretty well known. And that applies to most cryptocurrencies. If you're participating in DeFi, and that may be that you've got a significant amount of crypto sitting in your portfolio, you don't need to liquidate. You may actually put it in the equivalent of a savings account. You can stake it and earn 7 or 8% pretty easily. You can even earn higher than that if you know where to look. You may trigger specific income tax points. You need to understand where they are. And you also need to understand how that impacts your own tax and business accounting as an institution compared to a private investor. Now, coming back to NFTs, there has been a few regulatory changes in the space of crypto overall. And one of them happened in 2017 when there was a significant bull run for Bitcoin in particular and a whole lot of altcoins. The GST regulations changed to say that a supply of cryptocurrency is input taxed. It's a financial supply. And that was a good bit of clarification because everyone was scratching their heads saying, well, why does Bitcoin attract GST? It doesn't make any sense. That was sorted out. And of course, as I said before, there's a lot of innovation in this space. And since that time, we've had NFTs appear. And NFTs do not really fit the GST regulations definition of cryptocurrency at all. You can't really trade it for value. You can't, I can't give you an NFT for something in most cases. So at this stage, it appears to be that NFTs may attract GST in most circumstances, in particular when they're used in business. This much is not clear. There will be more in this space. So stay posted. Now, practically running your business and how it's going to operate when you've now integrated cryptocurrency, you're going to want to deal mostly in stablecoins. So it may be that you receive Bitcoin, and it used to be a bit of a marketing stunt to say, hey, look, we accept cryptocurrency. There are not that many businesses seriously doing it as of about 3 months ago. There are a lot more now. The uptake is now. People will accept Bitcoin. People will accept a few other kinds of coins usually. Often a business doesn't want to be exposed to that price volatility, which just the other day we had Bitcoin shoot up from 50K to 55K in the space of an hour. And that's not the kind of volatility you want for essentially your cash, because when you receive it, you pay tax on it, of course, as revenue. Often what you'll do is you will receive it and then you will liquidate it immediately into stablecoins. You'll hold it on your balance sheet as an equivalent to cash. You can convert it back to a cryptocurrency if you wanted to. And more in the future, we're going to see people spending their business cryptocurrency with another business. So don't say it's not going to happen. B2B transactions in crypto will become the norm, I think, at some point. Not all stable coins are built equally. So some stable coins, in particular, one called Tether, which is one of the industry standards, still has some controversy because a lot of these do have, as Shane said, some of them are built algorithmically, and other ones are actually built on having a one-to-one US dollar to one USDT in reserve. And Tether has not been the most transparent about that, so there is a bit of controversy about it. Businesses should still take care in this space. That's one of those things you need to look at. What stablecoin are we going to use? USDT is still the most popular, so you will be a bit bound to that, no doubt. But yes, just to refresh, we will liquidate pretty much straight away into USDT, and then we can take it off the exchange or into fiat currency through an off-ramp, which is most often through an exchange. Now, just running through a couple of, I guess you could say, examples. So there are a whole lot of issues in this space. This is really just meant to highlight what those could be. Say you're doing an NBA Top Shot type thing. You're creating collectibles. You're creating cyberpunks, were the most popular NFT collection probably the last few months. If you're generating an NFT, what are you doing it for as a business? Are you doing it as a marketing thing? Are you doing it to actually create value in it? There is actual value that you can create with an NFT. And you've got to go, well, am I creating something that's a CGT asset that I'm going to hold on the balance sheet, or is it something that's going to be trading stock? In the context of a business, it will most likely be trading stock. And those costs as well will pretty much always be deductible if that's the case. But if it's a bit of a marketing stunt, if it's anything else, there's so many kinds of uses for these NFTs. Then you've got to really assess, is that expenditure tax deductible? If you're working on the Ethereum network at the moment, those gas fees are quite expensive, and gas is what you need to pay to power the Ethereum computer to get it to do things. So if you want to mint an NFT, you need to pay gas, and that gas is quite expensive. And if you're doing a sizable amount, it can be millions of dollars. Actually understanding the tax consequences of those things before you do it is really important. And you also need to think about regulatory issues. Am I creating a security? Am I creating something that I need to disclose, especially if it's to consumers? Do I need a product disclosure statement? Do I need a financial services license? All those kinds of things make this space very difficult to operate. These are hurdles you can overcome, but you just need to think about things before you do them. Now, probably a more serious one that's going to get a lot more scrutiny from regulators is doing any sort of lending platform in the crypto space. And there are businesses out there that do this. And the biggest concern you're going to have is your anti-money laundering rules, your know your customer rules and things like that. You're still going to be under those rules if it's cryptocurrency. That much is made very, very clear. If that's what you're doing, you need to be looking very, very heavily into security, looking very, very heavily into your insurances. I've put it here in this slide, and I want to stress it. All wallets are created equal. There is no special forgot your password button. There is no special fraud department that will help you get your wallet back. Institutions are at the same mercy as the same wallet that I have. There are no special kinds of wallets. At its core, they are the same. There may be a few bells and whistles for certain offerings through providers, but at its base, if you lose your seed phrase, you are done for. You need to think of on and off ramping for businesses. If people are going to pay you cash to do some peer-to-peer lending in the crypto world, that you need to think about how's the cash going to come in, how's it going to go back out, those sorts of practical things, because otherwise people have their amounts locked up and they actually can't access them. And I mentioned it before, but Aussie banks are really sensitive to this right now. I've seen more than a few occasions of people's accounts being shut down unexpectedly because they put Bitcoin in the transaction description. You need to be really careful about those things. Finding a friendly bank is important, and it will most likely be a different bank than you do your business banking with. And most banks will be okay with that. They would rather not take the risk on. And if you find one that knows what they're doing, they understand this space, that's going to make you better positioned to not accidentally have your accounts closed and have walls put up by your bank, because it does happen to businesses as well. Now, I'm going to throw to Shane to take us through some example transactions, because the tax and legal stuff's fun, but the accounting stuff is where you get into the weeds, isn't it, mate?
Yeah, absolutely. So I've just got an example transaction on my screen here. This is, I suppose it's the equivalent of swapping Google stock for Tesla stock, but paying for the fee in Apple stock. So there's 3 different currencies involved in this transaction. It's actually a very realistic scenario. So what's actually occurred is that this particular client has traded on this exchange called Uniswap, which is one of those decentralized trading platforms that I discussed before. It doesn't take any custody. And they're powering this transaction with ETH. So they're spending this ETH to power the global computer, for lack of a better term. And they're selling Trendering for DAI. So they're selling 100 of this token for 528 DAI, which is a US dollar stable coin. So it's mapping 1-to-1 to US dollars. And the calculations behind this start to get pretty complex. So you could see here when we originally bought Trendering, it's $22. And when we sold it, it was $7.70. So we've had a loss of $1,560. However, you also need to consider the gain on the fee here. So originally we bought ETH at $600 and we've sold it $4,300. So there's actually a $61 fee gain on the ETH. And then that total value, which was really the fee, in this case has been associated with the cost base of that transaction. And you can see now that the total loss has been offset back down to 1,498. So you can imagine it's actually very easy to do many of these transactions, because the way cryptocurrency works, it tends to get broken up into smaller transactions because the divisibility. So it's not uncommon for an accountant to have a cryptocurrency user come through the door and they have hundreds, if not thousands, of these types of transactions. And what makes it even more complicated is that this transaction occurred directly on the blockchain. So there isn't a central third party called Uniswap that can give you a nice CSV of the client's transaction history. It's all just raw data on the blockchain. So just like you need a browser to be able to look at what's on the internet, you need software to be able to look at what's on the blockchain. So our solution is Crypto Tax Calculator. It's an accountant-grade solution. We've been offering our services in Australia now since 2018, and we've got hundreds of accountants, some of the larger accounting firms as some of our clients. We integrate directly with exchanges and blockchains. So essentially, as an accountant, you just need to gather up some data from the client that they can provide to you, which is safe and secure. And then we pull in all that data directly from the blockchain and the relevant exchanges. And then we can correctly calculate these types of transactions for you. And we handle some of those more complex scenarios such as NFTs and liquidity tokens and associated gas fees. So I'd welcome you all to leave any comments here or join us in the booth afterwards. You can learn more as well at cryptotaxcalculator.io, or you can also reach Harrison Dell at chamberlains.com.au.
Absolutely. Thanks, Shane. And yeah, it really is important to get both your accounting, legal, and just understanding what you're doing before you jump in. And the solutions are there. You just have to explore them before you start taking action. Isn't that right?
Yeah, absolutely. So, I mean, from working with accountants for a while now, common scenarios that a client has come through the door and they weren't really aware of the tax implications of their activity. And that can be a painful learning experience to realise exactly what your tax exposure is. So as Harrison pointed out, especially if you're a business, it's obviously a really good idea to get a solid understanding of what you're doing beforehand and seek the relevant advice.
Absolutely. I've more than a few times I've had to tell people that crypto is taxable and really burst their bubble. And it's really put them in a bad place when they've got 3-4 years and we're looking at, parabolic gains in the, 10,000% gains on investments, and they put their life savings into it. There's more than a few of those stories around. And those people are in for a rude surprise. And that's not what we deal with in the businesses. But businesses are more interested in getting it right the first time because you have, especially if you're a large or medium-sized business, you will most likely have at least annual contact with the ATO for a review product or at least some sort of guidance from them. And if they think that, if they know that you're dealing in crypto because it's on your website or whatnot, they're going to ask you those questions in the coming years. What is your governance like? How is that working? Because it's obviously a big risk for them about just visibility on where the money in the business is going. And this is probably the best way to track it, if by far the best way to track it, because as you can see, even a simple transaction is extremely complex. And imagine 10,000 of those. Imagine 100,000 of those for a business chain. That's just
you'd have yourself a tax nightmare, that's for sure.
That's right. And people are still trying to do it on paper, and it's just not possible.
Yeah, it's very hard to get accuracy, I suppose. Even the fact that, many cryptocurrencies have up to 24 or 36 decimal places, you could start to even with that fact, things start to get pretty complex pretty quickly.
Yep. If that's not in the weeds, I don't know what is, mate.
Yeah. Exciting place to be. I'm super excited about where the space will head over the next 10 years. As things mature in the ecosystem, I think people are going to realise significant opportunities where they can leverage this technology. But there's going to be a growth period there where, compliance and tax regulation becomes a really important factor in kind of where things move.
Yeah, absolutely, mate. And it's funny, you see the US and the SEC doing all sorts of things over there, and we're watching them. But the rest of the world is really watching Australia about how we're dealing with our tax regulation. The ATO is probably the leading authority in the world on interpretation on tax and crypto, and they're still very much in their infancy. There's still a lot to catch up on. So in the next 2 years, I just don't know how far we're going to be, but I think it's going to be a different landscape. But it's certainly exciting.
Yeah, definitely. Thanks for having us today. Really appreciate your time, and make sure you come join us at the booth.
Thanks all.